Welcome to the Deep Dive. Today we're digging into the latest earnings call from Carlsmed Inc., that's ticker CRRL.
And this was pretty interesting because it's their first financial report since they went public back in July.
Exactly. So we're getting that first real look under the hood. And what we see is, well, a bit of a contrast, right? Really strong growth on one side.
Oh yeah, impressive top-line numbers. But also continued spending and investment on the other. They're clearly building something.
Right. So the big question we're exploring for you today is, can Carlsmed take this innovative spine tech, this Aprevo platform, and turn that potential into, sustainable profit?
It's the classic post-IPO story in many ways. We've looked at the call, the financials, the commentary. Let's unpack it.
Okay, let's start with a quick snapshot of the Q2 results. Carlsmed really did deliver quite an impressive quarter revenue-wise.
Yeah, revenue nearly doubled compared to last year. Came in at $12.1 million. That was comfortably ahead of what analysts were expecting.
That's a strong start right out of the gate for a new public company. And they also confirmed their full-year outlook for 2025.
That's right. Still projecting annual growth between, 67% and 75%. So they're confident the momentum is continuing.
Definitely sounds like momentum. But beneath that shiny revenue number.
Right. There's the other side. The quarter saw a GAAP net loss of $6.8 million. So based on standard accounting, they lost money.
And adjusted EBITDA, which gives us a better sense of operational cash flow before certain items.
That stayed flat compared to last year, still a loss of $6.2 million. Reflects those ongoing investments we mentioned. It's costing money to grow this fast.
We also saw the gross margin dip just slightly, down to 73.4%.
Yeah, and management pointed to some expedite fees for production as the main reason there, getting things made faster to meet demand.
Okay, but on the cash side, they seem pretty solid after the IPO.
Very solid. They ended June with $33.5 million in cash, and then the IPO in July brought in another $93.5 million net. So plenty of capital to work with.
Got it. But the market's immediate reaction seemed, well, a bit mixed.
It was, wasn't it? There was that initial bump in after-hours trading right after the release, but then it sort of faded away.
Like a round trip. What does that tell you?
It tells me investors see the growth, they acknowledge it, but they're still looking for more. They want clearer signs of, margin strength and a definite path to actually making money, not just growing sales.
Makes sense. Okay, so with that overview, let's dive deeper into the financials and the strategy. That 99% revenue growth, almost double, where exactly did that come from?
Primarily from doing more procedures. They got more volume from surgeons who are already using their system, and they brought new surgeons on board too.
So broader and deeper adoption. What about the price per procedure?
It was interesting. It stayed pretty stable, right around $30,000 on average per procedure.
So the growth is real volume, not just price hikes.
Exactly, which is generally seen as a healthier sign, right? It suggests the Aprevo platform itself is pulling surgeons in, creating demand based on its value.
Okay, but back to the costs. That GAAP net loss widened a bit, $6.8 million versus $6.3 million last year. Adjusted EBITDA stayed negative, and that margin dip, those expedite fees, was that just a one-off or is it a concern?
Management framed it as needing to meet customer timing requirements. So paying extra to the contract manufacturers to get things done quickly, it's a trade-off.
Prioritizing getting the product to the surgeons quickly, even if it costs a bit more in the short term.
Seems like it. You could argue it's a strategic cost in these early stages. Build market share, keep surgeons happy, even if it slightly dings the margin for now. Especially in medtech, delivery speed matters.
And the operating expenses overall certainly reflect that investment push. Total OpEx jumped to $15.4 million from $10.9 million. Where did that increase go?
A big piece, about $3 million, was in sales and marketing. More salespeople, higher commissions because revenue is up, and more spending on trade shows and things like that.
Makes sense if you're trying to drive adoption.
Right. And then R&D ticked up a bit, mostly personnel costs for product development, including their AI work.
The AI initiatives, we'll come back to that. And G&A, general and administrative.
That rose by $1.2 million. Again, more people, but also things like legal and professional fees that just come with being a public company now. Startup costs of a different kind.
So a lot of planned spending to fuel growth and manage the public company infrastructure. How does the CFO see this playing out, especially the AI part?
Well, Leo Greenstein, the CFO, specifically mentioned the AI investments are key to scalability. The idea is, as AI gets more involved in designing the cases, it should reduce the need for human labor over time.
So improve efficiency, leverage the tech without cost scaling directly with revenue.
That's the goal. It fits their whole digital-first, make-on-demand model. They're trying to build a business that can scale more efficiently than traditional hardware companies.
Okay. And circling back to the balance sheet, $33.5 million cash end of Q2, plus $93.5 million net from the IPO. That gives them a good cushion. What's their cash burn rate like?
For the first half of 2025, they used about $15.2 million in operating activities. So that averages out to roughly $2.5 million per month.
With the cash they have now, that's a pretty decent runway to execute their plans.
Definitely. And importantly, they reiterated their full-year revenue guidance, that $45.5 to $47.5 million range, implying 67% to 75% growth for the year.
Sticking to the plan. That shows confidence, especially on your first public call.
Absolutely. It signals management feels good about the underlying drivers, particularly the lumbar procedures using Aprevo.
Okay, let's shift from the pure numbers to the strategy and what the leadership is focused on. CEO Mike Pardon sounded pretty bullish on the Aprevo platform.
Very much so. He's positioning it as the potential new standard of care for spine fusion. And he highlighted a really striking statistic.
The reoperation rate.
Yeah, an 82.6% reduction in reoperations after 1 year for patients treated with Aprevo. That's a huge number.
82.6% fewer reoperations. I mean, clinically, that's obviously massive for patients. But what about for the business, for adoption?
It's incredibly powerful. Fewer reoperations save hospitals and insurers a ton of money. It changes the conversation from, this is a better device, to, this is a solution that saves significant costs and improves outcomes. It's a very compelling sales pitch.
And are surgeons buying into it? What did they say about adoption rates?
They're seeing strong uptake. They reported 199 surgeon users by the end of Q2. That's up 72% from the year before, and apparently faster than they'd planned internally.
199 surgeons. How big is the total pool of potential users?
Management estimates there are nearly 4,000 spine surgeons just in the U.S., so 199 is still just scratching the surface. Huge runway for growth if they can keep converting surgeons.
And they have plans for that. Training and education?
Yeah. They mentioned a fellows training program, which is smart, getting surgeons early in their careers, and also a new Center of Excellence partnership with UC San Diego for live surgery observation, building that experience and confidence.
Okay, beyond the core lumbar market, what about expansion? I saw something about cervical spine.
Yes, that was a key update. They actually did their first personalized cervical spine surgery in July, just after the quarter ended.
Moving up the spine, literally.
Right. And crucially, they secured a Medicare New Technology Add-on Payment, and NTP, for these Aprevo cervical procedures. That starts October 1st this year.
Okay, NTP. Break that down for us. Why is that important?
Think of it as a bonus payment from Medicare to hospitals specifically for using innovative new technologies like this one. It helps offset the initial higher cost and encourages adoption.
So it makes it financially easier, maybe even attractive for hospitals to start using Aprevo for neck surgeries.
Exactly. This NTP provides up to an extra $21,125 per qualifying case. That significantly changes the economic calculation for a hospital.
And they're planning a full launch for cervical.
Yes. They've submitted the necessary 510K paperwork to the FDA for a personalized cervical plate. They're targeting a U.S. commercial launch in the first half of 2026.
How big is that cervical market?
It's estimated there are around 370,000 cervical spine fusions done annually in the U.S. So it significantly expands their total addressable market beyond just the lumbar spine.
That NTP approval seems like a really big validation and a potential accelerator then.
Absolutely. It's a major regulatory win and a strong signal about the perceived value and innovation of the technology. It should really help drive uptake once they launch commercially.
What about operational improvements? Are they getting faster at making these personalized devices?
They highlighted significant progress there. The turnaround time for the Aprevo system from planning to having the device ready is down from over 4 weeks previously to 10 business days or less now.
Wow, that's a big difference. Addresses a key practical issue for scheduling surgeries, right?
Definitely. And they attribute that to their model capital light, making things on demand, using digital tools. It supports that scalability idea we talked about earlier.
Yeah.
Less inventory, faster response.
Makes sense. And we touched on the CFO's comments about AI helping scalability. Anything else on the commercial side? How do they actually sell this?
They use a hybrid sales force. So some direct employees, but also contracted sales agents. This gives them broader coverage across the whole process, pre-op planning, helping in the OR, post-op support, potentially more efficiently than a fully employed team.
And they expect surgeons added now to drive revenue later.
Right. The idea is a surgeon added in one quarter starts ramping up their procedure volume in the following quarters. So there's a bit of a lag, but it builds momentum.
Got it. And they did mention seasonality.
Yeah, just acknowledge that the spine surgery market typically sees some slowdown in Q3, summer vacations and such. They expect that general trend will likely apply to them too, though maybe softened by their high growth rate.
Okay, interesting. So, shifting gears again, let's put our investor hats on. We mentioned that round trip stock reaction after earnings. What else are we seeing in terms of market context?
Well, since the IPO at $15 back in July, the stock IRL was actually down about 8.7% by late August.
Okay, so underperforming the broader medtech sector.
Yeah, the sector proxy, IHI, was down too, but only about 4.7% over the last month leading up to that point. So CRL lagged a bit.
It reinforces that show me story, doesn't it? Investors are waiting for more proof points beyond just the IPO hype.
Exactly. The broader spine market, the established players, they're growing maybe 4 or 5% a year. Carlsmed is showing this massive, near triple-digit growth.
Which is impressive.
Hugely impressive. But the market question is, can they turn that growth into durable profit in a way these established, slower-growing companies already do? That's the hurdle.
And what are the analysts saying? The sell side folks who cover the stock.
They've generally been positive. Initiations came out with buy ratings. Goldman Sachs put a $19 price target, Bank of America $16. They like the differentiated tech, the AI angle, the asset-light model.
But the market itself seems more cautious, balancing that potential against the current losses and the fact that it's still very early days as a public company.
Precisely. There's a disconnect, or maybe just a timing difference, between the long-term analyst view and the market's current demand for near-term financial validation.
So, looking ahead, what are the key things investors should be watching? The catalysts.
Number one is definitely that cervical NTP going live on October 1st. How quickly do hospitals adopt it? What impact does it have? That's huge.
Okay, what else?
Keep watching the revenue growth trajectory, obviously, making sure they stay on track for that full-year guidance. And crucially, any signs of gross margin improving or stabilizing now that the IPO is done?
So execution on the financials.
Right. Also, any new clinical data reinforcing those outcomes, like the reoperation rates, that always helps. And then, looking further out, that planned commercial launch of the full cervical platform in the first half of 2026 is a major milestone.
Basically, all eyes are on execution and hitting these upcoming milestones to build that investor confidence.
You got it. They need to consistently show progress on turning that potential into tangible, profitable results.
All right, let's have a bit of fun now with our not financial advice segment. Given this whole picture, the huge growth, the cool tech, the new market expansion, but also the market's caution and the path to profit still being mapped out, got any creative, maybe slightly wild trade ideas? Just for discussion, of course.
Okay, purely hypothetically, right? One idea that plays on the uncertainty and potential for a big move is a long straddle.
Buying both a call and a put option, betting on volatility.
Exactly. Maybe look out to the January 2026 expiration, perhaps around the $15 IPO price strike. Why? Because that cervical launch is planned for the first half of 2026.
So a potentially binary event around that time.
Right. If they nail the launch, show rapid uptake, maybe helped by that intake, the stock could really take off. But if there are delays or hiccups or the market just demands profit faster, it could easily retest or break below that IPO price.
So the straddle profits from a big move, up OR down, driven by that major catalyst. You don't have to guess the direction, just that it's going to move significantly.
It's a bet on high volatility tied to that specific execution risk and reward. Captures that uncertainty.
Interesting. Okay, what's your second idea?
This one's maybe a bit more nuanced. A calendar spread. You could, for instance, sell a near-term, out-of-the-money call, say the September $16 call.
Okay, selling that call captures some premium, betting it won't surge right now.
Right, reflecting that market hesitation we saw post-earnings. But you don't want to miss the longer-term potential. So at the same time, you buy a longer-dated call at the same strike price, maybe out to December.
Ah, so you collect premium short-term, but keep your exposure for later catalysts.
Precisely. You still have that upside exposure for when the NTP actually kicks in October 1st, and we start getting maybe some early reads on its impact towards year-end. It's a way to potentially generate a little income while waiting for those bigger catalysts to potentially drive a more sustained move later.
Selling the short-term doubt, buying the longer-term hope, essentially, using that market psychology.
Sort of, yeah. It's a more patient approach that acknowledges the current lack of immediate conviction, but stays positioned for future developments.
Both fascinating ways to think about the dynamics here. Again, folks, purely illustrative ideas, not financial advice.
Definitely not advice, just brainstorming based on the narrative.
So let's wrap up this deep dive. Carlsmed's Q2 showed impressive revenue growth fueled by Aprevo adoption. They're pushing aggressively into the cervical market with a key reimbursement win under their belt.
But the bottom line is still red. They need to show they can translate that top-line success and innovation into sustainable margins and profitability. That's the key focus now.
The regulatory wins are significant, the pipeline looks strong, but execution is paramount. For you, our listener, what's the single biggest takeaway here?
For me, it's that tension between potential and proof. Carlsmed has built a really compelling story around clinical value and market expansion. They have the pieces of the tech, the reimbursement wins like NTAP, but now the market needs to see the financial proof. Can they scale this efficiently? Can that AI and digital model deliver the promised leverage?
It really boils down to that, doesn't it? Turning innovation into a profitable, scalable business. That's the journey to watch.
Absolutely. It's not just about growing anymore. It's about growing profitably.
Just a reminder, everything discussed here is for informational purposes only. It's definitely not financial advice. Always consult with a qualified financial advisor before making any investment decisions.